Hello, everyone, and welcome back to the G360 podcast. Today, I am joined by Jeff Murphy, who is the market leader from Invesco and a subject matter expert of all things direct indexing. Jeff, it's great to have you.
Thanks for having me, Rex. Good to see you again.
Awesome. So today for our listeners, we're going to do a deep dive into all things direct indexing. Really start at a high level for an educational segment on what direct indexing is, how it can be super impactful to creating core foundational exposure for portfolios, and then dive a little bit into why it can be a useful strategy to significantly offset either capital gains, highly appreciated portfolios, and really a planning mechanism for strategic exits or exit liquidity planning. So, Jeff, I want to start the conversation by setting the foundation here as to what direct indexing is. And at its basic level, direct indexing is when we are matching or building an exposure of an index. So a client wants to have index exposure in either S&P 500, maybe a Russell 2000, or an all-world index. But instead of buying an ETF or an index fund, we're actually building that underlying index within the portfolios. And so can you just tell the listeners as to what the purpose of that is and why you would want to do that, of building the actual underlying positions?
Yeah, great for setting the stage there, Rex. There's, in this world, there's a few different ways to skin the cat. And yes, index investing has grown tremendously over the years. I think the next evolution of that is direct indexing, whereby the client owns the individual securities. So they have that transparency of owning the individual stocks, with the added benefit of being able to do tax loss harvesting. And I'm happy to go into that a little bit more, but think of direct indexing as owning an individual ETF, except with individual holdings and the ability to harvest losses.
Yeah, that's great, because we know that, at any given time, if the index holds 500 positions, that some of them may be appreciating and some of them may be actually going down. And so there's an inherent benefit of being able to take advantage of those stocks that actually do go down. So for our clients to understand, why would it be an asset to be able to harvest a loss or a position that's going down? Why would that be beneficial for someone?
Yeah, at first glance, it might be counterintuitive. Why would you want one of your stocks to go down, right? We're taught to buy low and sell high. So what's the deal with this? And the idea is that with direct indexing, we can give you market-like returns, benchmark-like returns. But when, let's say, you own Coca-Cola, and it drops in value, we can sell that and buy a similar stock like Pepsi and have that appreciate back up. So those two stocks in the same sector are highly correlated. You're going to get, at the whole, very similar returns between those two stocks. So they're largely interchangeable in the grand scheme of things, but we just locked in a tax asset. So when we lock in that tax asset, that capital loss, we can use that to offset a gain and thereby lower our tax bill.
Yeah, that's great. So, for our listeners out there, the beautiful thing about this is that we are getting that tax asset and we're able to track the index that they want to track within a certain level of confidence. And it allows you to generate those losses and take advantage of the losers, that we can then take those capital losses that we've generated and use them in other areas of their financial life, right? It might be that they have inherited a portfolio of highly appreciated assets, or they're an executive that's earning equity compensation and they've held on to those and those positions have done well. And now they kind of feel stuck from a tax perspective or trapped. So how are you seeing advisors work with direct indexing strategies to help those people that do feel trapped by taxes, whether you have RSUs that are highly appreciated, whether you're having a liquidity event of selling your business for a capital gain, for those people that have those big tax implications, why would they use something like direct indexing to help get them a foundational core index exposure, but do help to generate some of those tax losses? What are those use cases that you're seeing?
Yeah, it goes to the flexibility of the strategy, Rex. So in investing in a direct indexing account, you can access that by just funding it with cash. You can also fund it with
Hmm.
securities. So that could be stocks or ETFs. These are highly appreciated positions in many cases. And we can use the
Hmm.
power of tax loss harvesting to diversify and also mitigate that tax bill.
Yeah, absolutely. So let's dive into that flexibility a little bit more, right? Because every client that we meet with and that comes with us, whether you're a prospect or a referral, they come to us with an existing legacy account. For some people, that means they're all cash. And for some people, that means a mixture of appreciated positions or positions they might not want to own anymore. And so, walk us through the process of if someone does use direct indexing. Let's talk about just long only direct indexing for now. We'll dive into long short in the future. But for direct indexing, with someone has a concentrated position, they do have that flexibility to fund with their existing positions, right? It's not just we have to take a period of cash or a block of cash and you have to have that liquidity. You can utilize existing or legacy positions to fund this, correct?
Spot on there, Rex. So you can fund it with cash, you can fund it with stocks, ETFs, and in a perfect world, you could do it with both, right? Stocks and a mixture of stocks and cash, and that allows our portfolio managers to work the powers of tax loss harvesting, diversify the portfolio, and then mitigate any tax consequences for you, or some tax consequences.
Great. Yeah, absolutely. So now we have the potential to, just want to lay the set the stage for our listeners, right? You have your custodial account, whether it's at Fidelity or Schwab or any of our other brokers, and we're actually attaching you guys at Invesco as portfolio managers, or what we call SMAs, so separately managed accounts, where the assets are held in our client's outright account, but Invesco does have the ability to come in and trade that to their model. And we work with their portfolio managers to determine the flexibility of which index you want to track and also how much tracking error you're comfortable with. Can you explain what tracking error is to the listeners and why it's important in direct indexing?
Of course. So, tracking error is essentially the deviation from your benchmark, and we need to have some deviation from the benchmark in order to do tax loss harvesting. So, a little bit is
Hmm.
good. However, too much deviation introduces concentrations of risk. So, what we see
Hmm.
many times is that clients come to us with low basis, appreciated, concentrated stock positions. And, as you can imagine, it might
Yep.
be in the tech sector that's been highly appreciated, or other sectors as well. And when you're in just a few holdings relative to the S&P 500 index, for example, you experience high tracking error. And so therefore you have high risk relative to a
Hmm.
diversified benchmark like that. So one of our goals is to work with someone with a concentrated stock portfolio to mitigate that tracking error and essentially reduce those pockets of concentration in their portfolio.
Right, absolutely. And it's important for investors to know that tracking error can go in your favor or against you, right? And so it's just important when you're thinking about risk of a portfolio and what you're comfortable with when you set up the portfolio, that you determine what the adequate risk is that you're trying to seek, and then adjusting the parameters to if you have a big liquidity year where we're really trying to knock out some capital gain that you have, you might want to actually allow for a little bit more tracking error because that could have the potential of generating more capital losses, but you just need to know that you're going to be different from that index. And so that's why tracking error comes into play here. So, you talked about the idea of someone coming to you with concentrated stock positions, right? Let's take it to the next step. So we now understand what direct indexing is, where we're building the actual index in our account. we're harvesting losses when those positions go down and swapping a Coca-Cola for a Pepsi, for example, to lock in that capital loss. And then you now have that asset that we can then use, that tax asset that we can then use to offset capital gains that come from anywhere else in their financial life, whether it's concentrated appreciated positions, whether it's real estate sales, whether it's selling a business for a capital gain, or any other form of capital gain. Now, Jeff, we often see is a lot of people come to us with highly appreciated positions, right? And they might make up a significant portion of their portfolio. And so, talk to me about long short direct indexing. I feel like this year and last year, we've had a massive boom in interest in long short direct indexing. For Invesco, those are called the enhanced SMA models. And so, what changes when we start to implement long short direct indexing? And just give us a basic walkthrough of what that is.
Yeah, Rex, you hit on a topic that is really quite exciting. This is the next evolution of direct indexing, and it solves a few issues with traditional long only direct indexing. And I think that the first one to address would be when you get into a period of sustained rising markets, which we've experienced, in
Mhm.
several periods in recent years, you essentially run out of losses to harvest, right? Because really all of the stocks in the portfolio are rising, and you don't have those losses to generate those tax assets, and so that you're left with a portfolio of appreciated stocks that, as they
Yep.
continue to grow, they actually do increase in tracking error, right? Because we don't have the tools at our disposal to manage that portfolio
Yep.
closer to the index. And so you end up, in many cases, just having a concentrated stock problem. Um, where long short direct indexing comes in is using modest leverage and shorting to generate more losses and a more durable stream of losses for your portfolio. So your portfolio never ends up in that situation where rising tide lifts all boats and then you don't have losses to harvest, because let's
Mhm.
focus on the shorting, for example. Because we have some shorts and we're selling stocks short, when those stocks rise, they fall in value. We always have losses to harvest, even in those rising equity markets. And with the leverage,
Right.
with the longs, those are just more dollars to harvest losses with. It's more opportunity
Mhm.
for us to have at play. And when it comes to concentrated stock positions, clients can come to us and fund these accounts with those appreciated stocks. And we'll do two things. We'll diversify the portfolio immediately with the longs, and then we'll mitigate their concentration of risk by shorting similar stocks. So if someone comes to us with a Nvidia, for example, highly appreciated stock in the tech sector, we can use our short budget to short similar stocks in the tech sector and mitigate that risk. So it does a few different things, and it's a very
Yeah.
exciting time for this type of strategy.
S- Yeah, let's dive into that a little bit further, because I think it just goes back to the flexibility we talked about. Of one of the benefits of using direct indexing is that flexibility. Now, with long short direct indexing, I want to paint the picture for folks that have, little experience with this. Again, what you're doing is, if you have $1 million portfolio, you're collateralizing that $1 million and you're building extensions on both the long side and the short side. So, oftentimes you'll hear 130-30 or 145-45, for example, and it goes up from there. But what you are actually getting from that is, if you have 100% exposure as your core foundation of the portfolio, we're collateralizing that 100%. Let's call it $1 million for in this example, and we're building long extensions of 30% to the long side in this case scenario, right? There's a lot of flexibility about how much you can actually do there. but you're going long an additional 30% and you're going short an additional 30%. So it's important for investors to understand what the actual gross exposure will be. That comes with some risks as well. But it does allow you to say, do two things. The first is if you're funding it with cash, it puts more dollars to work, which means we have the opportunity to harvest more capital losses. And the idea of that, if we believe the market's going to go up over time, which it has historically, we won't see that ossification after years 3, 4, and 5 that we see in traditional long only direct indexing, where your only real solution is to add new capital to work or to start taking some money out, right? And so that would cause additional tax implications. And so for our clients that are thinking about how do we sort of supercharge this and how do we get an even bigger potential for tax savings, adding the long and short extensions can really supercharge that. And so again, it's really important for you to understand what the risks are that comes with this. But for a lot of our clients that have highly appreciated positions, this can be a total home run for them because they have the flexibility to either fund it after they have sold the position and work backwards, meaning if you have sold your appreciated position or you sold your business, and you now have lots of liquidity, but a big tax burden that's going to come to you at the end of the year, we can then build this long short strategy and work backwards so that when those shorts generate losses, or if the longs generate losses, we can really take advantage of those to help really pare down the capital gain that you have. So, Jeff, talk to us about when implementing the enhanced SMA for long short, right? What are the options for clients? Can they collateralize single concentrated stocks, or does it have to be for all funded with cash here?
What's great, again, going back to that word we've said several times, it's flexible. There's a lot of flexibility with this. So clients can fund it with cash. When they fund it with cash, they can immediately harvest more losses that way. They're completely diversified. They can fund it with securities. So in this case, that would be stocks or ETFs. We are seeing ETF funding accounts here. And when you fund it with securities, that does act as that collateral for the shorts and the leverage. You get diversification and you get tax loss harvesting ability. We're generally using the tax losses to offset the appreciated positions. So we're ideally working down those appreciated positions. So let's say, going back to that NVIDIA example I mentioned, someone comes to us with an appreciated NVIDIA position. We diversify the portfolio on the longs. We use the short budget to short similar stocks in the tech sector. And let's say in a given month, we harvest $6,000 in losses in the portfolio.
Yep.
We can use that $6,000 to pare down the NVIDIA position by $6,000. And so
right. And so it's kind of a win-win because you can get that immediate diversification through the longs, the immediate hedging through the shorts, right? And that's why you want a professional portfolio manager to do this, is because they can really look at that sector exposure. And I think a lot of listeners don't really realize that you can actually hedge a portion of that concentrated stock risk without actually selling it, right? And so you don't have to take the tax hit immediately. And so working with someone like an Invesco to utilize professional portfolio managers, you can wait for those extensions to harvest and then pare down that concentrated position. And so you don't have to take the gamble of, if this doesn't go my way, I'm still going to have to pay the tax bill. They will wait and they will pare that down. So it gives you the ability to create instant diversification in a tax neutral manner. And again, all of these, as we've said, multiple times today, you have the flexibility to set the standards that you want. If you want to blow out of everything at the start and work backwards, you can do that. And you would track the index a little bit more closely. If your goal is to do it tax neutrally and exit on a tax neutral basis, we can collateralize, build the extensions, and wait for the extensions to harvest those losses. So again, so much flexibility. It's just important for you to work with your advisor to determine, how much risk you want to take, what your overall goal is, and how do we back that into your financial plan, right? So, What about for our founders and our business owners? Jeff, if I'm a business owner and I just sold my business and now I have a lump sum of liquidity, let's say my business, the deal closed in January or February of the beginning of the year. Now I have a bunch of liquidity and all my assets historically have been tied up in this business. If I come to Invesco and we say, I want to build a foundation of a portfolio, but I have a huge tax bill looming at the end of the year. How does these strategies, specifically long short direct indexing, how does it work and how is it beneficial for someone in that scenario?
Business owners are great clients of ours, Rex, for this very, very reason. So I would start off by saying, if there's a business owner that is thinking about a liquidity event in the future, they should be thinking about this strategy in advance of the sale of their business,
Right.
because when you harvest losses, they don't expire. You can hang on to those. You can bank those losses over several years leading up to that sale of the liquidity event and mitigate that tax bill. So it goes to the preparation in advance of that liquidity event. So we deal with business owners pre-liquidity event and post-liquidity event, and the idea is all around
Mhm.
mitigating that tax liability that comes with the sale of a business.
Right. So a use case that Sam and I have experienced is when if you can sit in front of your clients that are business owners and you have an idea of when their deal is going to close, whether it's a year or two out, you can actually start these strategies, like you said, way beforehand and do some real liquidity planning where we could have a scenario where there's, in some cases, you can almost fully tax neutrally exit out of that business sale and do it tax neutrally. So it can be a total home run. It's just important to think about your timelines, make sure you have the liquidity to fund these accounts. But if you can address it early enough, again, you're getting the index exposure that you want, but we're just doing it in a much more tax efficient way. And so it allows us to do some real planning beforehand. And ultimately, the best thing we can do is plan before, because then that tax bill isn't going to be a surprise in the future. And if we have a long enough time horizon, like you mentioned, these losses do not expire. So you can build them up for 1, 2, 3 years before the sale, and then you're prepared so that when you're ready to go and that deal does close, in some cases you can have huge amounts of tax benefits and sometimes even fully tax neutral. So it can be a total home run for business owners. The other biggest area or biggest case study that we're seeing where we've had the most amount of success is for, the Nvidias of the world, right? This is, a stock that's been up a significant portion. And so if you have engineers or executives that have their compensation tied to this and they've been lucky enough to hold on to the shares that were granted, there's been so many AI winners this year. And so, we work with families that come to us and they say, look, we've had a home run year from investing. I couldn't have dreamed of this ever happening. I'm so happy, but now I need to think about my family, protect my family, and make sure that we can diversify. So utilizing something like a direct indexing strategy, specifically on the long short side for our ultra affluent clients, can be extremely beneficial to speed up the ramp of diversification in terms of how quickly we can get diversified to really help preserve and protect that wealth and lock in those gains that we had. So if you're out there with a concentrated position that's highly appreciated, you've had a great year, maybe you're in one of the AI stocks that have had an exceptional year, and you're ready to think about diversification to protect your family, talk to us. Just reach out, have an introduction meeting. We can introduce you to our partners like Jeff that are experts in this space, and we can run multiple different scenarios for you. The beautiful thing about direct indexing is that it does have that flexibility. So Jeff, you've experienced lots of investors that that have implemented direct indexing strategies. Are there any mistakes that you see that come up when, you're thinking about diversifying out of concentrated stock positions, or is there anything from a direct indexing structure that investors should be wary of? We talked about tracking error. Maybe we want to dive back into that, and maybe some of the risks that come with the margin around long short. But what do you think the biggest mistakes or challenges that people face when they do choose to use a strategy like this?
Well, I think that anytime you're incorporating leverage and shorting, there's a number of considerations that you would have around
Hmm.
that. And if we dive into a few of them, as you have more dollars at play, you could have some considerations around unwinding that leverage down the
Yep.
line, right? You can have
Yep.
again an appreciation problem if you're 130% long the market. Also, I think it's important to look at the short side of the equation as well. Again, we want to avoid those stocks that might grow to the sky, right? And what we want to do with our short side is really mitigate risk there. We're maximizing each short position at just 1% of the portfolio. So these aren't large
Hmm.
bets on the short side. Also, we're not shorting the biggest stocks in the S&P 500. Neither are we shorting the smallest stocks in the S&P 500 because those are hard to borrow securities and they can be expensive to borrow. So I would think about that
Hmm.
short book as the meat of the S&P 500, like the middle of the
Yep.
index. I think one thing that we don't talk enough about is how we can use those shorts to fine tune the risk exposure, and that's how we really narrow in that tracking error
Hmm.
on the S&P 500 or whatever index you decide to track. We can really narrow down how we want to fine tune our exposures and mitigate that risk within the index.
Yeah, absolutely. And I think it's important for listeners to understand that, you can't just short to generate losses, right? Because the IRS says that you need to actually be trying to make a profit on that, because if not, they would shut down the strategy. And so that's why it's so important to make sure that you're choosing the right SMA manager, someone who has experience and has been doing this for a while. And that's why we love partnering with Invesco, is because they are that trusted partner that we have. There's so much, I would say, buzz in our space specifically about these long short direct indexing strategies, and rightfully so, because they've been so beneficial to people that have these concentrated positions. But again, it's super important for you to do your due diligence on the manager, make sure that they have, dotted their I's and crossed their T's and thought about every way that this could go against you, and making sure that we build that into your financial plan of saying, like, how do we make a bulletproof financial plan so that we can implement a direct indexing strategy, whether that's long only or long short, to help provide the best possible solution for our clients. We talked about margin a little bit. I think it's important for investors also to understand is that for us, we have pre-negotiated margin rates. So there is a cost for borrowing, right? Historically, a regular margin cost can be very expensive, but we have gone out and, with Invesco, we now have partnerships with a Fidelity, for example, where we have pre-negotiated rates. And so that cost comes down significantly. Can you talk to our investors about how you set that up and why it's important to have those pre-negotiated rates when you're using, 130/30 strategies?
Yeah, it's a great point, Rex, because there's no free lunch in investing, right? And we want to deliver all of these benefits that we discussed. But if the cost is too high, it's just not going to work. So
Right.
how it works from a custodian standpoint, when you borrow money, you pay an interest rate, right? So when you're borrowing
Hmm.
stocks for your longs, you have to pay the prevailing rate at the time. And it's generally based upon the federal funds rate. So let's just call that 4%. And then we're also shorting by the same amount that we are borrowing. And what we've worked out and negotiated with a Fidelity, for example, is that we get a short credit because instead of borrowing, we are selling, and we're loaning
Hmm.
those securities. So when you lend something, you can get the interest rate, right? And so those offset to a large degree. It's not a perfect offset, but it does
Right.
significantly bring down the cost to operate this strategy into we'll call
Yeah.
it 25, 24 basis points of margin costs, which is very attractive.
Yeah, that's great. I mean, again, it's just so important to make sure that you're utilizing managers that have thought this through, that have built those relationships with the key custodians, because as these strategies continue to grow and gain exposure, it's important to have, a big player, because they can use that as negotiating power for our clients' benefit. So always important to, think about your manager and do your due diligence. Jeff, this was super helpful. I think if you're a client out there or a prospect out there, or anyone out there that has a highly appreciated position and they're getting a little bit worried about, they want to think about diversification, but they feel trapped from a tax perspective, talk to us. Schedule an introduction call with Sam or myself. We will introduce you to the folks at Invesco to help see what your options are and build a plan for you, where this can significantly help you either with your diversification to help get closer to index exposure, or to greatly benefit on the tax side of things. So again, if you're a business owner going through a liquidity event, if you're an executive earning equity compensation and you now have an appreciated position, feel free to reach out to us at Generation Capital Advisors. We're here to help. We're here to educate you and really to get exposure to these strategies in certain use cases where it can be a total home run. Jeff, thanks so much for your time. Do you guys have some great white papers and some great stuff going on social media? Where's the best way for them to learn more about what Invesco is doing?
We have a lot of stuff. There's content at our website. It's Invesco.com. We recommend that all clients go through an advisor like yourself, Rex. So I think you would be the first point of contact, and then we would be more than happy to help.
Absolutely. All right, Jeff, thanks very much for educating our listeners. We look forward to continuing our partnership with Invesco, and I hope everyone has a great rest of your day. Don't forget to hit that like button, subscribe, and share with your friends or anyone else that might be beneficial to listen to this episode. All right, guys, have a great rest of your day. We'll talk to you soon.
Thanks for listening to the G360 Wealth Podcast. If today's episode gave you something to think about or act on, share it with someone who might need it. Don't forget to hit subscribe so you're always in the loop. If you want to learn more about how we help families like yours simplify and grow their wealth, visit us at generationcapitaladvisors.com. Until next time, take care and keep building. The information covered and posted represents the views and opinions of the guests and does not necessarily represent the views or opinions of Generation Capital Advisors. The content has been made available for informational and educational purposes only. The content is not intended to be a substitute for professional investing advice. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your investment planning. Investment advice offered through Integrated Partners, doing business as Generation Capital Advisors, a registered investment advisor. The information in this material is for general information only and is not intended to provide specific advice or recommendation for any individual. Integrated Partners does not provide legal, tax, or mortgage advice or services. Please consult your legal or tax advisor regarding your specific situation. All investing involves risk, including loss of principal. No strategy assures success or protects against loss.